Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey, welcome back to Big Money Real Estate. This is my Wednesday interview program where I talk to some of the smartest people about money, real estate, economics, all the rest. And it's here on Expert Real Estate Tips, my channel at YouTube. I'm Elise Glank. I'm here to help you make really smart choices with your money and real estate. I'd love for you to subscribe for weekly insight and tips from the real estate and personal finance experts I interview on this show, and you can do that by just clicking on the red button. This week, my guest is Jonathan Smoke. He's chief economist at Realtor.com, and I invited him on the show this week because I want to have a conversation about last week's jobs report and about what's going on with the Fed. While the economy added fewer jobs than expected, the unemployment rate held steady at 5.1%, and even the U6, which as all of you know is my measure for sort of the broad rate of unemployment, that even dropped a bit down to 10%. But there seems to be a lot of slack in the labor market. It's not like your paycheck's increasing, is it? And you need look no further than actually there was a decrease in the average hourly wages in September. So I asked Jonathan to come on to share his take on the unemployment numbers, but also to talk about how these numbers could affect the real estate market. And then again, what the heck is going on with the Fed? Jonathan, welcome back to Big Money Real Estate.
Thanks for having me, Elise.
All right, where do you want to start? There's so much to dig in. Jobs?
Yeah, I think jobs is a very important place to start, and that September report was a blow. I would say that this has been the best year clearly we've seen in housing since the downturn. So 8 or 9 years, depending on what metric you're looking at. And I would argue what has been driving this has been the robust recovery in jobs and the very solid pace of job creation that we've been seeing. Because there's a critical relationship between job creation and household formation, and in the absence of household formation, you don't really have fundamental demand for housing. And we saw in that report not only a disappointing number for September, but also a revision to August and July that essentially meant that our pace of job creation was down for the first time in almost a year. And that doesn't bode well for seeing the same kind of job creation and household demand over the next year that we've seen so far. So it was important to understand what's happening.
So what's interesting to me is that as we've looked back and we saw July and August be revised downward, we've also seen the number of homes sold, sort of the people who are putting houses under contract, right? So that future look, those had been dropping as well since the spring. It was kind of strong in January, February, March, and then all of a sudden we saw it kind of tailor off. And I'm wondering, clearly those two things are tied together. What do you think is going on with jobs, though?
Well, I think jobs is a reflection of the manufacturing sector and the energy sector both being weak this summer because of the increase in the value of the dollar, and that impacting exports, and of course the weakness in oil causing job declines in the energy sector. So I think that's principally what's happening there. In the grand scheme of things, in the economy, that's less than 10% of the U.S. economy. Housing actually plays a much more significant role to the economy, so we should be able to handle that. But to see the pace, except we're seeing declines, right?
Right, except that we're not, and even in new construction, which is where I think housing really gets the big boom, right? Which is when you have all these people building new houses and then the furnishing of the new houses, the sale of the new houses, that's still at only about half of where it should be. I mean, I think we're going to end up, it's definitely better. We're not at 300,000 like we were a few years ago, and we're not at 400,000 like we were last year, but are we going to actually crack 500,000 new homes sold? Maybe, but we should be at way closer to 1 million new homes sold. And when you're building and selling an extra 500,000 homes, I would imagine that's a pretty big jolt to the economy.
That's right. The biggest multiplier for the economy coming from housing is from new construction, and specifically into what you were just describing in single family new construction, meaning we see a much higher multiplier coming from single family homes versus apartments versus just sales of existing homes. So you're absolutely right. That's where we need to see the biggest increase, and we haven't. We've seen solid, consistent, gradual increases. This could be a year if we in the year strong that we finally see a double-digit increase year over year. But
Woo!
in recoveries past, you would have seen a 30 to 40% type of recovery, and that's just not materializing.
And the whole recovery thing, anyway, is kind of strange, right? Because technically, the recession, the Great Recession, ended 2009, 2000. I mean, I guess you could
Yes,
say, I mean, it ended in
that's right.
2009, and now we're at 2015. We're 6 years out from the technical end of the recession. I would argue that for so many people, it's never ended. This is, so now I want to move a little bit to how the world is doing, if you don't mind getting a little macro with me, or very macro, global. Um, the whole issue with China and what China's growth definitely slowing, how much it's slowing is a concern. The sort of the world angst that's going on with Syria, Russia, ISIS, how Asia is playing into that, versus the U.S., versus some of the other players that are kind of fighting ISIS. How does all of that slowing and kind of this political focus, and now we're getting into an election cycle, seriously into an election cycle, how is all of that going to affect real estate and the market and what the Fed is doing? Because I would have laid a dime to a dollar that the Fed would have raised interest rates this past cycle because they didn't want to get into next year in a presidential election cycle to start raising interest rates. Right then, people are going to say, "Hey, the Fed is so political." They're running out of time. What's your take?
Yeah, I totally agree with you. I was myself hoping for a rate move back in September just so that we would get that behind us. But I think the global weakness is clearly what the Fed communicated that they were most concerned about. And of course, the absence of seeing strong evidence in the data that inflation has become a problem allowed them to kick that can even further down the road. But what we've been seeing, I believe, this summer is really a reflection of that global weakness. And one word probably describes what's been affecting the U.S. market in particular, and that's uncertainty. Because again, while China is a major part of the world economy, its impact directly on the United States is actually relatively small. We don't send too many exports directly to China. Just the reverse. We actually buy quite a bit from China, and that's exactly why you see the trade deficit widening currently, because the strong dollar and the weakness there is essentially creating a scenario where consumers are really benefiting in the short term. But that uncertainty really has unrattled financial markets around the world. That provided essentially pressure to the Fed that even if the Fed had raised short-term rates, we likely wouldn't have seen a similar increase in long-term rates because globally that they're more reflective of what financial markets are doing. And it's that uncertainty, I think, that caused the declines and weaknesses and gyrations, huge gyrations in the stock market that started happening in July, continued and got even more severe in August and September. And I actually think that's the issue that has caused existing home sales and pending home sales to decline in August. And it's the impact of seeing suddenly your stock portfolio down 10%
It's
in
a
1 or 2 days.
psychological thing, right? It's really psychological. People are looking at that and they're thinking, I'm not as wealthy as I was, so maybe I don't do anything. And certainly for millennials who should be jumping into the housing market, we already know and have talked ad nauseum about how they're just waiting to do everything. Waiting to get married, waiting to buy a house, waiting to get a job, waiting to move out of mom and dad's house, whatever it is. I do want to ask you, though, about, when it comes to the global markets. We saw the week start. This is going to air on Wednesday, so we're taping this Tuesday for Wednesday. But yesterday, Monday, We saw the stock market jump up again. It had, to your point, big gyrations. I had a conversation with some money managers last Thursday and Friday, people who probably together run tens of billions of dollars. One is a big guy, runs a lot of money for Morgan Stanley. Another guy who really, I think, is very interesting and was one of those people who called the 2007, 2008 thing, bet against the market, made a fortune. These guys, there were 5 or 6 of them sitting on my stage, and we were running a discussion about what was going to happen. And to a person, none of them think we're in good shape. All of them, and there was a range here, so I want to describe the range. One guy is already buying gold. I mean, and not just like gold futures, not gold bricks. He's buying like smaller pieces of gold, which he plans to store in a mountain in either Switzerland or in Singapore. He hasn't decided yet. He thinks the world is ending tomorrow. And by that, I don't mean that we're all blowing up. I mean that the stock market and kind of the financial world, he thinks what happened in '08 is going to go a little bit further. On the far side, we had somebody who said, yeah, we're going to have a huge crash, but not for 18 months. That was the range I got from them. Are you hearing this sort of stuff from your cohorts economically?
No, I would say that those sound a bit to be outliers. But the funny thing is, the people that are very focused on the financial market seem to be where those perspectives are coming from. I've been attending several economic-oriented conferences lately, and I would say people in general are expecting continued gradual improvement. That's a bit of why the September job report was such a surprise. But I would say no one's really factoring in worldwide calamity. That does remain a risk. I mean, you've got political uncertainty and and problems that can completely destroy all models and how you're looking and forecasting the future. But a variety of factors within the U.S. Remain very resilient. One of them is demographics. We were at a point back when the financial crisis were happening where actually we would have probably seen some decline in housing regardless, because we were essentially dependent on the smallest generation, Generation X, which I'm a member of, to drive the housing market. And that generation is the smallest generation we have today. And the pure numbers just weren't in our favor for household formation and the kind of demand that you would see for robust housing. We're in an entirely different place today because we've got these 2 huge cohorts of the baby boomers all turning 55 by 2019, so being in those prime years for making retirement housing decisions and also having the most money that they're ever going to have. And at the same time, we have millennials exactly in that range where they should be buying homes. And indeed, we're starting to see that happen. But what you really see is that there's huge differences by market around the country. And you're really seeing that being driven by job creation, and it's attracting household formation and population. So there's some fundamental growth that's occurring here that we really didn't see back in 2007, 2008. So I don't think the level of risk is nearly as big. I'm just simply focused on, if we wanted next year to be as strong as we've experienced this year, are all the factors pointing in that direction. And I would say it looks like it's going to be good, but probably not as good next year as this year.
So bottom line, next year not as good as this year for real estate.
That's what, if this job trend continues, and it's some very simple math. If you think about the job creation we've had, we had been averaging about 3 million jobs on a trailing 12-month basis. Guess what the household formation has been on a trailing 4-quarter basis?
What?
1.6 million. And so the funny thing is, when I started in this business over 20 years ago, some very wise people said, hey, it's all about jobs. For every 2 jobs, you should have 1 household created. And we're seeing that exact math kind of play out. So if the job market isn't as robust, you won't see as much demand. And especially on the new construction side, I think you're going to continue to see only slow but gradual recovery.
And of course, let's factor in the presidential election, where we all know from the 20 years I've been doing this that the 9 months preceding a presidential election, all real estate slows.
Yeah, there's a lot more uncertainty, a lot more of policy risk, a lot more questions about interest rates. And so
And
you ask,
deductions. What's
yeah,
going to happen to that deduction I'm counting on, all the rest.
yeah. And actually, the funniest thing about all the gyrations we've had in August and September is that this consumer confidence actually increased in both of those months. And so there are truly a lot of puzzling metrics coming at us, and it looks like it's a bit bigger range of possibilities, let's say, that could be occurring not only through the end of this year but into next year, precisely because of all those things happening at once.
Well, we'll definitely have you back in about a month to talk about where we are as we get officially 1 month out, 1 year out from the presidential election. We're going to start doing a countdown, and we'll have you back to talk about where we are at that time. Jonathan Smoke is chief economist for Realtor.com. Jonathan, thank you so much for being with us.
Thanks, Elise.
And thank you for watching this episode of Big Money Real Estate. As always, I would love to hear from you, so send me some questions or comments on Facebook and Twitter. I will answer them on future shows. Be sure to share this video with everybody you know on social media and even people you don't. And if you're interested in real estate investing, you will learn a lot from my series, The Intentional Investor, How to Be Wildly Successful in Real Estate. Check it out at thinklinkstore.com. I'll see you next time. I'm Elise Kling.